The great financial illusion? What if the financial system wasn't designed to make you wealthy, but to keep you dependent? What if the advice you've been given, buy high-growth stocks, time the market, chase returns, is actually the fastest path to mediocrity? And what if true financial freedom has almost nothing to do with being right about the market and everything to do with being ready for anything? Welcome. Today, we're not just summarizing a book. We're dissecting a financial revolution. Unshakeable, your financial freedom playbook, co-authored by Tony Robbins and fiduciary advisor Peter Mallouk, isn't another get-rich-quick manual. It's a forensic audit of the financial industry, a masterclass in behavioral psychology, and a step-by-step blueprint for building wealth that survives recessions, inflation, panic, and time itself. If you've ever felt confused by conflicting advice, anxious about market volatility, or frustrated that your investments aren't working as hard as you are, this is your reset. We're going deep. Every principle, every data point, every psychological trap, every actionable step. Let's begin.
Dalio Inc., a leading financial research firm, has tracked investor behavior for over 30 years. Their finding is consistent and stunning. The average equity fund investor earns less than half the return of the funds they invest in. Why? Not bad funds, bad timing, driven by emotion. This cycle isn't theoretical, it's neurological. When markets rise, dopamine drives euphoria and FOMO. When they fall, cortisol triggers fear and loss aversion. The result? Buying high, selling low, repeating. Tony Robbins didn't just read books, he sat down with the living legends of investing. And across ideologies, value, growth, macro, activist, one consensus emerged. The goal isn't to be brilliant. The goal is to be rational, disciplined, and unshakable. Ray Dalio's principle: never bet against compounding. Protect your downside, and the upside will take care of itself. Warren Buffett's rule. Rule number 1, never lose money. Rule number 2, never forget rule number 1. John Bogle's legacy. Don't look for the needle, buy the haystack. These aren't slogans, they're survival strategies. Let's decode them.
Section 2. The 3 Silent Wealth Thieves. Deep Dive. 2.1. Thief number 1. Fees. The compound killer. Let's look at how fees compound over time. If you invest $100,000 at age 25 with a 7% annual return for 40 years, a low-cost index fund charging just 0.1% in annual fees would grow to roughly $1.5 million. An average mutual fund charging 1% would leave you with about $1 million. And a high-fee active fund charging 2% would shrink your final balance to just over $700,000. That 2% fee doesn't just cost you 2% each year, it quietly consumes more than half your potential wealth over a lifetime. And fees are layered. Expense ratios cover annual fund management. 12b-1 fees are marketing costs disguised as service charges. Load fees are upfront or back-end sales commissions. Transaction costs hide in bid-ask spreads and market impact. Advisor commissions bake conflicts of interest directly into recommendations directly. The solution isn't complex. Use low-cost, broad market index funds from providers like Vanguard, iShares, or Schwab. Target expense ratios below 0.25%. Prefer ETFs over mutual funds for better tax efficiency. And audit your statements annually, questioning every single line item. 2.2. Thief number 2. Taxes, the invisible drain. Taxes aren't just an annual event. They're a structural design challenge. The Unshakeable investor uses asset location, not just allocation. For example, bonds that generate high ordinary income belong in tax-deferred accounts like traditional IRAs or 401k plans. Stocks that pay qualified dividends and generate long-term capital gains are best held in Roth accounts, where growth and withdrawals remain completely tax-free. Low-turnover index ETFs work beautifully in standard taxable brokerage accounts because they rarely distribute taxable capital gains. And real estate investment trusts, which pay out high ordinary income, should also live in tax-deferred shelters to avoid annual tax drag. The book also emphasizes advanced tactics like tax loss harvesting,
where you sell depreciated positions to offset gains while carefully avoiding wash sale rules. Roth conversions allow you to move traditional IRA funds into tax-free accounts during low-income years. Municipal bonds offer tax-free income, especially valuable for high earners in high-tax states. And simply holding investments for over 12 months qualifies you for significantly lower long-term capital gains rates. 2.3. Thief number 3. Inflation, the silent eroder. Visual time-lapse animation. $100 bill shrinking in purchasing power from 1980 to 2026. Host. $100 in 1980 had the buying power of roughly $380 today. Cash isn't safe. It's slowly confiscating your future. To beat inflation, the book recommends anchoring your long-term portfolio in equities, where companies can raise prices to protect margins. Real estate provides natural inflation hedging through rising rents and property values. Treasury inflation-protected securities, or TIPS, adjust their principal directly with consumer price index data. Productive businesses and cash-flowing assets generate returns that outpace currency devaluation, and strategic commodity exposure, like gold or energy, acts as a historical hedge during monetary expansion. The key isn't to flee cash entirely. It's to ensure your long-term portfolio is anchored in assets that grow faster than inflation, while keeping short-term reserves liquid and protected. Section 3. The Core Strategy. Asset Allocation Masterclass. 3.1. The 90% Rule. Why allocation beats selection. Landmark research shows that over 90% of a portfolio's long-term variance is explained by asset allocation, not stock picking, not market timing. This is the single most important insight for the everyday investor. 3.2. Building your unshakable portfolio, the core satellite framework. Your core portfolio should be built like a fortress. Start with U.S. total stock market exposure, allocating roughly 40 to 50% of your holdings through broad index funds that capture the entire American economy. Add 15 to 20% in international developed markets to diversify beyond U.S. borders and hedge against domestic economic shifts. Allocate 5 to 10% to emerging markets, which carry higher volatility but offer long-term growth potential. Anchor the portfolio with 20 to 30% in high-quality bonds, which provide stability, predictable income, and rebalancing fuel during equity downturns. Finally, dedicate 5 to 10% to real assets, like REITs and inflation-protected securities, which act as natural hedges against purchasing power erosion. The satellite portion of your portfolio is where you explore, but with strict boundaries. Limit sector ETFs like technology or energy to just 3 to 5% of your total holdings. If you pick individual stocks, cap each position at 2 to 3% and never let them exceed 5% of your overall portfolio. For alternative assets like gold or small cryptocurrency allocations, keep exposure between 2 and 4%, treating them as non-correlated diversifiers rather than core wealth builders. And if you have access to private investments like angel syndicates or private real estate, allocate only 2 to 4%, recognizing these are illiquid and reserved for experienced or accredited investors only. 3.3. Rebalancing, the automatic buy low, sell high machine. Visual, animation, portfolio drifts over time. Rebalancing triggers systematic trades. Host. Imagine your target is 60% stocks and 40% bonds. After a bull market, you're at 75-25. Rebalancing means you sell 15% of your stocks, taking profits at market highs, and use those proceeds to buy bonds while they're relatively undervalued. You then return to your original 60-40 split. This isn't prediction, it's discipline. It forces you to do what feels wrong, but is mathematically right. You can rebalance on a calendar basis, like annually or semi-annually, which is simple and predictable. Or you can use a threshold-based approach, rebalancing only when any asset class deviates more than 5% from your target, which is more responsive to market swings. A hybrid method works best for most investors. Check your allocation quarterly, but only execute trades when those thresholds are actually breached.
Section 4. The Psychology of Wealth. Rewiring Your Financial Brain. 4.1. The Behavioral Finance Toolkit. 7 biases that... Let's walk through the psychological traps that silently drain portfolios. First is loss aversion, where the pain of losing money feels roughly twice as intense as the joy of gaining it. This drives investors to sell during downturns and miss recoveries. The antidote is pre-committing to holding periods and using stop losses only for speculative positions, never for core holdings. Second is recency bias, the assumption that recent market trends will continue forever. This leads to chasing momentum or abandoning value after crashes. Combat it by studying long-term market history and writing cycle reminders directly into your investment policy statement. Third is herd mentality, the urge to follow the crowd for safety, which pulls you into bubbles and out of market bottoms. Break this by defining your own criteria and muting financial media noise. Fourth is overconfidence, the belief that you can time the market or pick winners better than professionals. Track your decisions against a simple index to ground yourself in reality and embrace uncertainty. Fifth is anchoring, fixating on a past price, like waiting for a stock to return to your entry point before selling. Shift your focus to current fundamentals rather than historical cost. Sixth is confirmation bias, where you only seek information that supports your existing beliefs, causing you to ignore warning signs. Assign a mental devil's advocate for major decisions. Finally, there's present bias, the tendency to overvalue immediate rewards over future security, leading to undersaving and high-cost debt. Automate your savings and regularly visualize your future self to align short-term actions with long-term goals.
4.2. Building Your Investment Policy Statement, IPS, Your Financial Constitution. Your IPS is your anchor. When emotions run high, you don't decide, you execute. It begins with a personal mission statement, like, my money exists to provide security, freedom, and impact. You then define your specific goals and timelines, whether that's retirement at 60, an education fund in 15 years, or legacy planning in 30. State your risk tolerance clearly. For example, I can withstand a 30% portfolio decline without changing strategy. Map out your target allocation using the core satellite breakdown we just covered. Establish rebalancing rules, such as reviewing quarterly and acting only when deviations exceed 5%. Lock in your contribution plan by automating monthly investments into core holdings on a fixed date. Define an emergency protocol. If you lose your job, you will use cash reserves, not sell investments. And finally, set advisor guidelines, committing to work only with fee-only fiduciaries and reviewing costs annually. Write it, sign it, date it. Review it every January. This document transforms you from a reactive trader to a strategic owner.
Section 5. Navigating the Financial Industry. Finding True Allies. 5.1. The Advisor Spectrum. From Salesperson to Fiduciary. The financial advisory landscape operates on two fundamentally different standards. On one end is the suitability standard, which governs most broker-dealers. Under this model, advisors are only required to recommend products that are suitable for your situation, but they often earn commissions, trailing fees, and third-party incentives, creating a high risk of product bias. This structure works for one-time transactions, but misaligns with long-term wealth building. On the other end is the fiduciary standard, which governs registered investment advisors. Fiduciaries are legally and ethically bound to act in your best interest at all times. They typically charge transparent, fee-only compensation, whether through assets under management, hourly rates, or flat project fees, minimizing conflicts of interest. This model is designed for ongoing financial planning and long-term partnership.
5.2. The fiduciary verification checklist. Visual. Interactive checklist with green checkmarks. Before hiring anyone, ask 7 direct questions. First, are you a fiduciary 100% of the time in writing? Second, how exactly are you compensated? Please show me the fee schedule. Third, do you receive any third-party payments, trips, or incentives? Fourth, can I see your Form ADV Part 2A, the official fiduciary disclosure document? Fifth, what is your investment philosophy and how do you handle market downturns? Sixth, how often will we meet and what's included in your service? Seventh, can you provide references from clients with similar goals? If they hesitate, deflect, or use jargon, walk away. Your wealth deserves transparency.
Section 6. Advanced Protection Strategies. 6.1. The Liquidity Pyramid. Layering your financial defense. Think of your financial defense as a layered pyramid. The foundation is your emergency cash reserve, holding 6 to 12 months of essential living expenses in a high-yield savings account or money market fund. This is your psychological safety net, designed to prevent forced selling during crises. Above that sits your core portfolio, your diversified, low-cost, long-term investment engine that you never touch for short-term needs. At the peak is your speculative satellite, reserved for high-risk, high-potential investments with strict position sizing limits. This top layer allows controlled exploration without ever threatening your foundational wealth. 6.2. Downside risk management, beyond diversification. Diversification reduces risk, but doesn't eliminate it. Add these layers. Apply stop-loss rules strictly to satellite positions. If a speculative holding drops 20%, reevaluate the fundamentals, and if the original thesis is broken, exit. Enforce strict position sizing. No single stock should exceed 3% of your portfolio, and no single sector should exceed 15%. Maintain a 2 to 5% cash buffer specifically to deploy during extreme volatility, turning panic into purchasing power. And review your insurance coverage regularly, ensuring disability, life, and umbrella policies protect your human capital alongside your financial capital.
6.3. Tax-efficient withdrawal strategies in retirement. In retirement, the order you withdraw money matters as much as how much you saved. Generally, you should draw from taxable accounts first, selling investments with the lowest capital gains to preserve tax-advantaged growth. Next, tap into tax-deferred accounts like traditional IRAs or 401k plans, strategically managing required minimum distributions to avoid bracket spikes. Finally, preserve Roth accounts as long as possible, using them for large, unexpected expenses or legacy transfers, since growth and withdrawals remain tax-free. For advanced planning, consider Roth laddering. This involves converting small amounts from traditional to Roth IRAs during low-income years to fill lower tax brackets, effectively creating a pipeline of future tax-free income.
Section 7. Beyond Accumulation. Purpose, Legacy, and Generosity. 7.1. Defining your enough. Tony Robbins asks, what is the purpose of your wealth? Without clarity, more money just raises the goalpost. Try this exercise. List 10 things you'd do if money were no object. Circle the 3 that matter most. Calculate the annual cost of those 3. That number, not an arbitrary million, is your enough. Financial freedom is reached when your passive income covers that number consistently. 7.2. The Generosity Multiplier. Research shows giving activates the same brain regions as receiving, but strategically, generosity also builds social capital and networks, shifts your mindset from scarcity to abundance, and creates legacy beyond balance sheets. Start small by automating 1% of your income to a cause you genuinely care about. Consider donor-advised funds to get an immediate tax deduction while distributing grants over time. Explore impact investing to align your capital with values like clean energy or education. And involve the next generation in family philanthropy to teach responsibility alongside giving. 7.3.
Legacy design, beyond the will. True legacy isn't just assets. It's values, wisdom, and impact. Write an ethical will, a personal letter sharing life lessons, values, and hopes for your heirs. Establish family governance through regular meetings to discuss wealth, purpose, and responsibility. Use education funds like 529 plans or trusts to empower the next generation's growth. And remember that mentorship, your time and wisdom, may be your most valuable gift. Section 8. The 90-Day Unshakeable Implementation Plan. Phase 1. Foundation. Days 1 through 30. Week 1 is your financial audit. List all accounts, holdings, fees, and beneficiaries. Calculate your current asset allocation. Identify high-cost funds to replace. Week 2 is IPS drafting. Use the template linked below. Define your goals, risk tolerance, allocation, and rebalancing rules. Share it with your partner for alignment. Week 3 focuses on fee optimization. Move high-fee funds to low-cost index alternatives, consolidate accounts where possible, and set up automatic contributions. Week 4 is advisor vetting. Interview 3 fee-only fiduciaries using the checklist, verify credentials through the SEC IAPD database, and begin transitioning if needed. Phase 2, optimization, days 31 to 60. Week 5 covers tax strategy. Meet with a CPA or tax-savvy advisor, implement tax loss harvesting if applicable, and optimize account location. Week 6 is risk management. Fund your emergency cash reserve, review insurance coverage, and set stop-loss rules for speculative positions. Week 7 builds behavioral safeguards. Unfollow financial media that triggers anxiety, institute a 48-hour cooling-off rule before any non-automated trade, and schedule quarterly IPS review dates. Week 8 focuses on legacy. Draft your ethical will, research donor-advised fund options, and discuss values with your family. Phase 3, automation and mastery, days 61 to 90. Week 9 achieves full automation. Automate contributions, set rebalancing alerts, and track net worth using a spreadsheet or dedicated app. Week 10 commits to education. Read one classic investing book per quarter, starting with Bogle's The Little Book of Common Sense Investing, and subscribe to evidence-based research sources. Week 11 stress tests your plan. Run what-if scenarios like a 30% market drop, job loss, or major expense, and ensure your system holds without emotional decisions. Week 12 is celebration and reflection. Acknowledge your progress, refine your IPS based on what you've learned, and share your journey to inspire others. Section 9. Common objections and unshakable responses. Let's address the pushbacks. Some say index funds are boring and they want to pick winners. Remember, boring builds wealth. Excitement destroys it. Let your satellite satisfy curiosity without risking core capital. Others claim they don't have enough to start. Start with $25 a month. Consistency beats size. Time is your greatest asset. What if you need the money soon? Then it doesn't belong in stocks. Match your timeline to the asset class. Cash for under 3 years, short-term bonds for 3 to 5, equities for 5+. Some argue the world is different now and past returns don't guarantee future results. That's true, but human behavior, compounding math, and fee drag are timeless. Focus on controllables. And if you've already made mistakes and wonder if it's too late, remember, the best time to plant a tree was 20 years ago. The second best time is today. Compounding rewards patience, not perfection. Closing. The Unshakable Promise. Recap and call to action. Let's crystallize the essence of Unshakeable. Volatility is guaranteed. Panic is optional. Prepare, don't predict. Fees, taxes, and inflation are silent killers. Audit, optimize, protect. Asset allocation drives results. Diversify broadly, rebalance systematically. Psychology is the battlefield. rules over reactions, IPS over impulse. Your advisor must be a fiduciary. Align incentives, demand transparency. Wealth is a tool, not a trophy. Define your enough. Build legacy, not just balance sheets. This isn't about becoming a financial expert.
It's about becoming financially free. Free from anxiety. Free from dependency. Free to live by design. The market will drop again. Headlines will scream. Experts will contradict. But if you control what you can, fees, allocation, behavior, advisor choice, and accept what you can't, timing, macro shocks, noise, you become unshakable. Financial freedom isn't a destination you reach. It's a system you build. And that system starts with one decision: to stop reacting and start executing.
Call to action. Join the Unshakeable community. If this masterclass added value to your life, subscribe and hit the bell. We drop evidence-based financial education every week. Comment below. What's the one step from the 90-day plan you'll take this week? I read every comment. Download the free resources in the description, including the investment policy statement template, fiduciary verification checklist, fee audit worksheet, and asset allocation calculator. Share this video with someone who needs clarity, not hype. Tag them below. Next week, we break down the psychology of money by Morgan Housel. Why doing well with money has little to do with intelligence and everything to do with behavior. You don't need luck. You don't need genius. You don't need to time the market. You need a plan. Build it, protect it, compound it. Stay disciplined, stay unshakable. I'll see you in the next one.